Good afternoon, everyone. Thank you so much for joining us today. My name is Sameer Paranchpe. I head the forensics practice at Thornton and welcome to this webinar on insider trading, decoding insider trading inside out. Today we have a packed session and I hope it is worth your time today. In the beginning, I will have a quick 20-minute presentation in which I'll just take you through the key concepts of insider trading and just give you some real life case studies. I'm from forensics, right? War stories is what our presentation entails. And then we have a power pack panel in which we have participation from different parts of the industry. So we have got financial services experience talking about how they manage insider trading in a financial services setup. We have got a large listed entity being represented by their legal and compliance head who will talk us about how does he deal with the demon of insider trading. And we'll always also bring the legal view in which we have a lawyer talking us about, sorry, in which we'll have, sorry for that, in which we'll have a lawyer joining us, talking us about the legal aspects of insider trading. And of course, this will be moderated by a seasoned forensic professional. But more of that, let's first dive straight into the presentation. As I assure you, will be done in 20 flat minutes. I don't want to keep you away from the fantastic panel we have got lined up. So just give me a minute. I hope everybody can see my screen. So as I said, it is preventing insider trading inside out. What we are going to do today is really 2 or 3 quick things, right? One is I'll give you a regulatory perspective in terms of how Indian regulations have evolved over the last specifically 2-3 years, and how does that compare with some of the more developed economies, and what action has really SEBI taken in that regard. Then we come to the more interesting part in which we talk about modus operandi typically used by insider traders and some case studies. Of course, these are real life examples, some of which we may or may not have been involved in. And we'll talk about some of them just to sort of glean some learning from that. Some do's and don'ts right at the end of it, and then we dive straight into the panel. So moving on, I love this quote. I know it's slightly tongue-in-cheek, but if companies tell us more, insider trading will be worth less. So with that, we start off into what is really insider trading, right? So let's sort of lay down what the definition is. So insider trading, simply put, refers to trading of shares by an insider based on unpublished price-sensitive information. It involves buying or selling shares, trading stock, using information that is not yet out in the public domain, but can materially impact the stock price. Now, there are 2 things that we need to understand. One, what is unpublished price-sensitive information? Seems a mouthful, UPSI. And what is an insider? So let's start with UPSI first. Now, UPSI means any information which relates to the matter or is of concern directly or indirectly to a company and is generally not known. So one, it is of concern, it matters significantly, either directly or indirectly related to a company, and is generally not known or published by the company for general information, which means if published or known, it is likely to materially affect the price of securities in the market. So that's why unpublished price sensitive information. Now let's move on to insider, and that's where things get slightly tricky over here. So insider is anybody who sort of connected with the company or deemed to have been connected with the company and is reasonably expected to have access to such UPSI. And we'll cover, because insider, what is an insider, who's an insider, that has really evolved over the years and it evolved so much to include a whole gamut of actors. So we'll deal with what do we mean by an insider. Now, what is types of unpublished price sensitive information? As I said, anything that is of significance, that is of concern, and that can materially impact the stock price. So it could include obviously intuitively financial results, intended declaration of dividend, any mergers, acquisitions, divestments happening, disposal of any particular thing. And in fact, since we are in a post-pandemic world or a pandemic world, depending on what point of view you look at, even the health of the key promoters or key managerial personnel of the company, even that is unpublished price sensitive information. Because let's take example of and this is just as an example, let's take somebody like Elon Musk, who's essentially the face of Tesla and probably is Tesla Incorporated for all practical purposes. Any information about his potential health, and there was some scare some time back, is obviously significantly material to the stock price of Tesla. So clearly that is unpublished price sensitive information. Now coming to what really do we mean by an insider? The the old school version was obviously key managerial personnel, the CEO, the board, the CFOs, the CXOs, who have information about the company, about its results, performance, any strategic initiatives, strategic moves they are making in the marketplace, which is as of now not yet published. But in this era of social media, the definition of insider has changed. What now? Who is an insider? It could be a whole host of people, right? Last but not the least, starting with the auditors. Auditors have access to unpublished price-sensitive information, have access to how the financial performances of company is going to be, how is it trending over the last few quarters, few months, and hence are in pole position to understand how the company is doing and what its performance would be. Extended team, outsourced staff, consultants, advisors, IT service staff, they obviously have are an extended team and have deep knowledge about the company and its key initiatives. Eavesdropping, very, very important. In a company, generally there is something called as, in the olden times when it was not work from home, and I'll talk about how COVID has changed that. Coffee group, boiler room conversations or coffee table conversations used to be on how the company is doing, what has worked well, what is not well. So a company who typically, an individual who typically will not have access to information as a part of his or her daily role may get access to such information. Digital and social revolution has literally changed the rules of the game, right? So you have youngsters going out on Facebook and bragging about what they are doing at work. Who knows, there might be somebody trawling through your history to identify what your company is doing, what are your plans, and I'll talk about a couple of examples on that. And last but not the least, corporate espionage. And we have worked on multiple such cases whereby people specifically in the tech and who have a lot of valuable IP join a particular company for 3 months, and 3 months later they scoot from the company and carry with them significant amounts of data and intelligence. And we are typically called upon to investigate such cases. So corporate espionage. So as you can see, insider from the good old KMP days has obviously evolved to include a whole host of people who might have access to UPSI. Now let's look at the numbers. As I said, SEBI has made some interesting moves and sort of a lot of changes over the last 2 to 3 years. Now let's look at what is the regulator's approach. First, SEBI seeks to establish, the first port of call is it seeks to establish who is an insider, who typically would be the KMPs, company board, auditors, per person handling financial information, sensitive information, and even close relatives of them. The second is to understand what really is UPSI, what really is unpublished price sensitive information. As I said, it could be anything, and we have seen upon examples. And lastly, in order, the clinching part when it comes to sort of convictions or taking law to its logical conclusion is who traded on that information. So the link that SEBI follows is who's an insider, what access to UPSI did he or she have, and how has that benefited in terms of trade on the stock market. That's typically the approach that all regulators all over the world follow. Now let's look at it from a statistics perspective. Now the highest number of insider trading cases detected was 34 in 2016-17, which jumped to 17, 18, 19, and then sort of came back to about 49 in 1920. As per a study by New York University, 1 out of 4 public M&A transactions, that's 25%, are corrupted to some extent by insider trading. I mean, that's a lot. And it has been openly sort of, that's the theory going around, that insider trading in the US stock market happens at least 4 times more than regulators actually catch and prosecute. It's generally considered that the US SEC is reasonably more proactive compared to regulators around the world in catching insider trading cases, and we will sort of come back to that, come back to the question both in the presentation as well as the panel as to why is that. And insider trading, which typically they are said to be more potent, but even then, it is assumed that insider trading in US stock markets happens at least 4 times more. Now, coming back to more current data, SEBI has taken up in 18 to 21, it took up about 164 cases and 122 were completed. Now, as I said, the crucial link in conviction is who communicated insider trading to whom and what were the gains made due to that. Unless there is specific evidence of these 2 aspects, conviction will be difficult to get. And our lawyer panelist will touch upon that in her panel. SEBI has also, as a part of sort of, in order to get people to sort of blow the whistle more often, and there is enough materials available which says that the best way to detect fraud in 50% cases, it is a whistleblower. So SEBI has also increased informants reward to 10 crores to restrict possible insider trading. And it's prior to 2021, and it's a recently made thing, it was 1 crore. So now let's look at the regulatory framework in terms of, let's say, an India, US, and a UK, who are at different stages of their evolution. How does this match up? Specifically, let's start with India first. So India, the applicable statutes are the SEBI Act of 1992, the SEBI Insider Trading Prohibition of PIT Regulations, as it is called, is 2015, and the Companies Act 2013. Obviously, long overdue regulations, specifically the inside PIT regulations in 2015 and the reference to it in Companies Act 2013, obviously was to overcome the misuse of power, determine conflict of interest, and strengthen retail position. Obviously, the impact of this has been there has been duties of directors and managing and supervisory boards have been outlined clearly, and there has been a permitted flow of information as well. This is where I was talking about the comparison between the Indian and the US and UK regime. Now, insider, the three key differences are who is an insider, the criminal liability, the monetary liability, and the total reward paid to the whistleblower. Now, as an insider, typically, as per Indian regulations, as we just discussed, refers to a person who was or deemed to be connected with the company and reasonably expected to have access to UPSI. So it's fairly qualitative in nature. As per the SEC, insider refers to a person who directly or indirectly is the beneficial owner of more than 20%. So they have clearly quantified it, direct or indirect owner of a more than 20% of any class of any security, or who is a director or officer of the issuer. So fairly clear there. As per UK, again, it sort of goes back saying regulations apply to anybody who engages in the relevant behavior in relation to qualifying investments, also a person dealing off market and not restricted to authorized persons. So they have sort of kept it as broad-based as possible. This is sort of from a insider definition perspective. Now, from a criminal liability perspective, I think as per Indian regulations, it is punishable with imprisonment, which can extend up to 10 years. In the SEC, it is a maximum allowable prison sentence of 20 years. And as per the UK, is it a maximum allowable prison sentence of 7 years. Now, the real difference lies in the monetary penalty. So as per Indian regulations, it is 5 times or 25 crores or 3 times the profit made on insider trading, whichever is higher. The SEC is fine up to 3 times the profit made or loss avoided. That's an interesting thing. So it's not just gains made, it is also loss avoided. And the UK is again very, very broad-based saying unlimited fine. And total reward, we just had a look at it. Therefore, for Indian regulations, it is 10 crores. For the US, it is 10% of the amount recovered from the profit made. And in some of those instances, if we just Google it up, some of the cases that have been there, those have been phenomenal sort of gain, phenomenal amounts that were potentially made from insider trading. And obviously, the monetary penalty was also huge. And UK, there is no such reward to inform them. Now, in terms of, as I said, the more interesting part, the more forensic bit, in terms of what are typically in our experience, what are the modus operandi followed, and some case studies on that. So typically the cycle works like this, right? Individuals associated with the company directly or indirectly come in possession of UPSI. The individuals who have the UPSI pass it on to connected entities. Basis that the connected entities take a market position based on the UPSI. On publication of the UPSI, they square off their positions, and then unlawful gains are made by both the connected entities and the person who passed on the UPSI. So information received, information passed on, position taken, position squared off, money realized. Simple 5-step process. Now, what the kicker or the bull in the china shop in this case has been the social media part in sharing UPSI. As I said, I had talked about it in the introduction as well. Now, social media has really changed the name of the game by providing a platform of instant messaging service for sharing all sorts of communication. More importantly, most of these platforms provide end-to-end encryption. I think there are enough sort of social media essentially extolling the virtues of it in its adverts recently, right? End-to-end encryption, which makes it very, very difficult for regulators to monitor the content. Now, what happens typically, and one of the modus operandi that we have seen is private social media groups are created, most easily on WhatsApp, maybe Facebook as well, to share UPSI. Reuters had done an expose on them some time back that messages have been circulated, which have come to the regulators' notice, which accurately predict the earning pattern just before results are announced. So if if there are people who know what the earnings are going to be, how much up, how much down, what is going to happen, and given especially the pandemic times when there have been vast swings in terms of financial performance, clearly the amount of mischief of insider trading UPSI is massive. There is one case that comes to light. There is an investigation currently on by a regulator, whereby one obviously a very young person joined a company which was about to go public. Obviously, he, having spent a couple of years, got what are called as ESOPs. The fact that the company was going public was not known. And our friend then decided in this amount, probably after a drunken night with his friends or whatever, decided to put it on one of the social media platforms saying, guess what, big bucks coming my way. That's all he did, right? There were people who picked it up because they were apparently scrolling his social media page and took positions on it. And then that came to the regulator's notice, which then started looking at his social media chat. Because it was not WhatsApp and it was one of the other social media platforms, they could sort of go back and probably go through the data to identify, had our friend sort of leaked anything. And that's when his message saying big bucks coming my way came out, and essentially there is legal action going on here. So clearly, as I said, social media, did he do this with the intention of passing on UPSI to make a gain? The answer is no. But should he have been more responsible? The answer is absolutely yes. And that's where I said social media has completely changed the rules of the game and made it far more difficult for regulators to track, as well as for individuals to understand the ramifications of their actions. One measure that was recently reported in the media is SEBI is in the process of building its social media technological capability to monitor and prevent market manipulation, and has already undertaken a massive data lake project to augment analytical capability. So in terms of red flags, I'll skip this. I'll come straight to the case studies. So there are 3 or 4 case studies. I'll at least talk about 2 or 3 of them. I'm conscious of time. So there was this pharma company, the Food and Drug Administration of the US announced that it would not approve a new cancer drug. As a result of which, obviously, the market price dropped. However, the family and friends of the promoter were not affected with such drop in share prices because they had obviously sold their shares before the announcement of FDA's decision. However, what came is Simran, an individual with absolutely no links to the company, had also followed suit and made huge profit by selling massive pharma private limited shares days before the FDA announced. Now, based on the investment conducted, what came to light is obviously the promoter and his friends were aware of this and had offloaded their stock. However, the promoter and Simran shared a common stockbroker. The stockbroker tipped off Simran saying, you know what, there's no point holding on to massive pharma shares. Why don't you sell it off? So based on a tip from the stockbroker, Simran also followed suit, made money, and Raj, Simran, and the stockbroker had contravened insider regulations that faced regulatory action. The other sort of interesting part, more dealing with FS, is in investment bank was underwriter for a fresh issue of shares of 3 companies. The regulator had obviously noticed that there was some inappropriate pattern or weird pattern in the shares of the above 3 companies, and a regulatory investigation was on. Now, what happened is the KMPs who obviously had access to UPSI had shared the information with their hedge fund managers and retail bankers in return for business. The hedge fund managers informed their clients and the retail banker informed their clients. They took positions based on that information and all of them made a killing. Obviously, however, the regulator took note of it and there were stringent penalties imposed on that investment bank, resulting in revocation of their entire ongoing underwriting project, resignation of the KMPs, and obviously resultant fall in stock price and profits. I will come to the last one. Again, a company typically engaged in GHF in a B2C business. They were working with some other entity for launch of a streaming platform, and hence the stock had been rallying for a long time. The regulators alert system generated trading alerts for the SIP around the time of the corporate announcement with the launch of the streaming platform, and obviously identified there were some issues in terms of in an unusual pattern. So what came to light is one of the individuals who was working at a senior position, was aware of what was going to happen with the streaming platform. Based on a review of his employment history, call data records, KYC details, it was identified that he had communicated this information to 2 people, who further communicated to 3 more people, and everybody had made a pot of money. So all the 5 individuals, along with the corporate executive, were debarred from buying, selling, dealing in securities, and obviously involved further regulatory action. So there are sort of multiple sort of ways in which this is done. So just some do's and don'ts in terms of what sort of helps us to ensure that we are able to mitigate the insider trading risk. As I keep telling all my clients, any risk is a mathematical formula. Opportunity into intent. Intent is something that, apart from the Almighty, none of us can do anything about it. All of us as risk management professionals have to focus on reducing the opportunity. So from a do's perspective, obviously clearly define UPSI, conduct awareness and training programs, because as I said, individuals, youngsters, people are not aware of what they might view as simple actions, the harmful effects it might cause not only to them, but to their other corporate, but to their company as well. Ensure proper disclosures as per SEBI norms, establish code of conduct, ethics and culture policy, as well as a whistleblower policy. Please ensure that it just does not remain as a poster in the HR or the chief ethics officer's room. Please ensure that you walk the talk and establish a code of conduct and ethics policy, and then you implement it rigorously. And obviously set up a whistleblower policy, because that expands your ability to detect this fraud. From a don'ts perspective, obviously don't do insider trading. More importantly, trade in securities when compliance officer has disapproved the trade. Don't do that. And do not even unwittingly let out any sort of information to anybody which might be construed as UPSI. With that, I will take a pause here and sort of move on to the next part of our event, which is the panel discussion. And it gives me great pleasure. As I said, we have people from 4 different streams of stakeholders as far as insider trading is concerned. First up, we have Tushar Gunderia, who's the Senior Vice President and Head and Legal and Compliance Head of Blue Dart Limited. So he is the representative for the large listed entity. Then we have Manjari Tyagi, who's a corporate lawyer with Shardul Amarchand and is a partner with them and specializes on capital market transactions and sort of deals with these issues on behalf of clients. And last but not the least, we have S. Swaminathan, a financial services industry veteran who has been in insurance for nearly 30 years and probably brings with him the financial services perspective. The moderator of this panel will be my colleague Dinesh Anand, who's the national managing partner for risk and private equity at Grant Thornton. Again, a seasoned forensic professionals who has been in forensics and incubated forensic firms in the country for more than 20 years. So Dinesh, over to you.
Thank you, Samir, and thank you for the presentation. I think it was very insightful. No matter how much one speaks about prevention of insider trading, it's something which we always need to be aware of. A warm welcome and a thank you again to the panelists. Very happy to have you, Swami, Manjari, and Tushar. Thank you for taking time to come and join this panel. I think let me quickly start, and the first question going to Swami, and picking it up from the last slide of do's and don'ts which Samir put for us. How do you manage the risk of insider trading? And like what Samir had mentioned, have you defined a code of conduct for UPSI, and how do you ensure compliance of the same? It'll be great to get some insights from you.
Okay, thanks, Samir, for that insightful and always interesting subject of insider trading. Okay, anything which is an insider is interesting, so that's how things go. And the more you conceal, the more it is interesting. That's how the human mind works. So, which is good. See, ours is let me give you a short background. The background is that we are an unlisted company. As an insurance company, we are an unlisted company, number one. Number two, my promoter also is an unlisted company, Tata Sons. It's a private limited company for that matter. Okay. And number three, we are an institutional investor, because a major part of my my revenue is from markets. So we are an important player in the market, while at the same time our shares are not listed. So while the UPSI applies, it applies to the limited extent of my team having information about other companies. and that information that they get to know by way of interacting with other investors, interacting with corporates, interacting with brokers or other intermediaries, in all of those interactions. So and this has kind of grown up in importance and criticality over the years when insurance companies have started actively pushing what you call unit linked kind of products, where market is then becoming plays a key role. So as a company, what we have done is, yes, deriving from IRDA's investment regulations, and IRDA's investment regulations refers to SEBI regulations on insider trading. And IRDA does not prescribe the internal guidelines, but says that you have to have a guideline in line with SEBI's stipulations. So yes, we have a personal trading guideline where we have clearly defined two parts. One is who is a designated person and who has access. Okay, because someone like me, I do not have concurrent access to investment tradings on a daily basis. Okay, whereas my investments team, which is the front, mid, and back office, as well as my concurrent auditors and the finance team, they have concurrent access to trades. So we have kind of demarcated them and have disclosure requirements under my personal trading policy, which is a policy which is approved, recommended and approved by the investment committee, number one, and then by the board also. And that's the policy which even the regulator relies on when he does a inspection or review. So that policy, okay, there's some echo. Right. So that policy kind of defines who all does it apply to in terms of designated persons and access persons, what kind of disclosures do they have to make yearly, on a trigger of a transaction, quarterly, all of those. Who are the immediate relatives of those access persons who also will be expected to follow these guidelines. And within that also, what we have still done is given some kind of a flexibility to the both the access persons as well as designated person, is in terms of up to what limit can you trade in a month without seeking prior approval of the compliance officer and the investments officer and the CEO. Okay, so that kind of helps them have their personal trading also, and all those trades are concurrently monitored both by the compliance team and as well as the concurrent auditors. So we kind of monitor the trades that happen. We do listen to calls at random, pick up some calls, listen to the calls, and then match up the calls with the deals that are done. So kind of, keep a tab on almost on a daily basis as to what kind of trades are taking place, and is there any aberration that we can see? Is there any trend that we can see? So those are monitored. We have a system in place, which is an internally developed system where employees or these access persons and designated persons are expected to, seek approval wherever they need to seek approval, and also make their quarterly disclosures and annual disclosures. Having said all of this, we have still found a couple of deviations there. People, let's say I've given a limit of, for namesake, I've given a limit of, let's say 10 lakhs per month for an employee. It does happen at times that he's crossed that limit. So, consciously we make life slightly difficult for that person so that he's kind of more aware the next time. And while no specific, the action that is taken on such a deviation depends upon whether we are able to establish an intention there, and if he has made a profit out of it. And there have been a couple of instances where employees have made profit, but we have asked the employees to kind of donate that profit to CSR, thereby being fair to the employee. And all these are reported to my investment committee and thereby to the board. So broadly, when all these things are put in place, as a company which is an influencer in the market, but not having an internal UPSI situation, we are kind of assuring ourselves that we are following all the guidelines in spirit also stipulated by SEBI as well as my regulator. So that's how we kind of operate. Dinesh.
No, thank you, Swami. While I want to go to the other panelists, I have another question, which is kind of a follow-up question, and especially, when you spoke about the actions which you take, when you find employees who are non-compliant. So the question I would have is, do you think relying on self-declaration, and self-declaration is something which we follow, right? Whether it's, whether it's in Grant Thornton, or whether it's, most of the firms which are required to comply with it, or active monitoring, right? There are two things. And of course, there are certain situations which, like you mentioned, where you do a mix of both. What would be the mode in your experience you would rely more on? Would it be more of self-declaration, more of active monitoring, a mix of both? What has worked? I think it'll be good to understand that. And I know there's no real easy answer to that.
Okay, let me draw an analogy, or rather, my regulator's name is Insurance Regulatory and Development Authority. Okay, I follow a similar principle of regulation as well as development. So you need to give the flexibility to the employee and have the lay down the required trust in him that he will follow the rule. And having said that, also say that in God we trust, the rest give me data, and therefore rely on data. Okay, so we have to have a combination of both. It can't just be one. It's like saying that I expect all the players in the football field to abide by the rules. Having said that, I'll still have a referee there, with the relevant controls in hand. So we have to have both. It's a combination of both is what we operate, not only for insider trading, but even largely for all compliances. No,
it makes absolute sense. But the only thing I would say is, right, for all the players to abide by a rule, the person who matters the most is the coach, which becomes the organization. So, what does he do to make sure that he relies on them? But no, thank you. That's great insights. And now, I wanted to, direct the next question to you, Tushar, right? We have had many instances where, senior management has indulged in insider trading, and the general excuse which we have seen is either attributed towards having inadequate knowledge or lack of awareness about the regulations, right? So what is it that Blue Dart is following, and what kind of training awareness sessions are you doing to prevent any insider trading? So what's been your experience? We would love to get some insights on that.
First of all, thank you, Dinesh and Samir, for giving an excellent overview of these insider trading provisions by depicting these PPT slides. It was an excellent overview and coverage. See, as far as Blue Dart Express is concerned, as you are aware, it's a listed company, with a high market capitalization. So we are having some really stringent policies. Apart from the statutory requirements of having a Blue Dart, SEBI insider trading code, which all the companies, have to formulate. So we have our own Blue Dart, Blue Dart Express insider trading code, as well as code for fair disclosure practices. And as far as we are concerned, we have also, of course, it's a mandatory requirement also. We have, made a group of designated officials, and, every year we try to cover maximum employees in that group. So these are the designated officials which are supposed to have access to unpublished price sensitive information. So we send the trading window emails, stock exchange communication, which is nothing but a statutory requirement. But apart from this regulatory requirement, as a good governance practice, and I would say as a control and vigilance mechanism, we have also, we are having a tool, specific insider trading tool, which automatically, even if somebody doesn't make a disclosure if he has bought or shares, the monthly MIS and the monthly, exception report comes to me and to my colleague. So we will come to know, okay, yes, this person has, if he has bought the shares, then we will just ask the question to him. So far, fortunately, nothing has happened. So, there is a, inbuilt vigilance mechanism, and I feel in today's, dynamic capital market scenario, these, all the corporates should have very aggressive and vigilance mechanism as well, because self-declaration, yes, people may just, it may just become a just signing of a document and, just making a declaration to the organization, which in any case, we are also taking annual declarations from all the employees. And what I have suggested in our organization, without prescribing limit, first of all, as a matter of policy, what we do, generally, we don't encourage, designated officials to go for buying of the company's shares, because at any point of time, generally, it is always, when insider buys the shares, he buys with the expectations that, at one point of time, it is going to go up. So as a matter of not policy, but general governance practices, we discourage. And if the law permits and the policy permits, there is a pre-clearance set process. The compliance officer approves. So before he buys, we come to know, and it is always a very negligible quantity. And we also log it with our stakeholders relationship committee, which is also majority of the directors are independent directors. They are eminent professionals. We inform them whenever there is a, we have an investors analyst meet, we do a prior intimation to the stock exchange, which is again a requirement. Then, video transcript of the whatever the questions are asked, the list of participants who participate in the analyst or investors call, we notify to the stock exchange. Then also, as a, like, I would say, again, a good governance practice, we also make a, we observe once in 6 months or once in a year, I would say, compliance week. So, this, we, where the knowledge and awareness about this insider trading code, what are the implications, what are the recent judgments, where the corporates, have been penalized, we know all the even leading companies, sometimes, the articles gets published. So we make the people aware, conscious of these, repercussions of these insider trading violations or non-compliance. And at times it could be because out of, it could be unintentional, but the law itself is, it presumes that, you've done this intentionally. So that aspect is made aware to all the designated officials. And we make a, whenever I send that trading window mail, at that time, even if it is, as a matter of practice, I send that PPT presentation every once in 6 months I send. So the message is constantly reiterated. And wherever the updates are required, we, update the PPT presentation on the insider trading code with the latest judicially pronouncements on the subject. So, and of course, even with outsiders, because insider could be like, external, consultants or external parties who are dealing with the, so trading window email also goes to them well in advance. And we try to, widen this list of these outsiders also who may be having, some information just because they are advisor to the company. And further to that, we have also gone for, taking confidentiality undertakings on the stamp papers, that, since you are dealing with the company, you may be having access about the company's information. So you are requested to please sign off this. And of course, before the audit committee also, this control mechanism, whatever the listed companies are having it, once in a year, it is required to be placed before the audit committee. So it is also placed, whatever the inputs or suggestions comes from the audit committee, that is also, we try to implement. And also we have a committee, there is a formal structured committee of managing director, that is CEO, CFO, and me. So there is a committee. So whenever any case or whatever the suggestions or inputs are there, if you have to amend the policy, so committee meets and makes whatever the appropriate amendments. And at times, I believe on this subject, it is at times it is better to keep reiterating the message. It is better to over communicate rather than to under communicate. So these are the broad things, we follow.
No, thank you, Tushar. And I guess the key takeaway, and I completely agree with you, the constant communication, the training, constantly communicating and increasing awareness is actually the best way you can do that, so that tomorrow nobody can have an excuse to say that, I was not aware about a regulation, or I did not know that there's a specific window where I cannot trade. Thank you for that. I think moving to Manjari, and Manjari, it'll be great, as a lawyer, as somebody who has, is constantly, I'm guessing you've helped enough clients deal with this issue. And what would be the broader trends you are seeing with respect to regulations in India on prevention of insider trading, right? There's been a lot of talk happening. So what's your view with respect to the trend in terms of the regulations?
Sure, thanks for that, Sameer. I think, as we're all aware, our regulations went through a major overhaul in 2015 when the 1992 regulations got replaced with the 2015 regulations. And since then on, in the last 7-8 years, what we've seen is further iteration of the regulations. I think SEBI's been, sort of had its ears to the ground to the extent that there are a lot of market participants who are constantly engaging with SEBI and, sort of pushing through some of the things that are required to ease the ability to do transactions, the ability to do to trade, etc. And I think in some measure, we've seen that come through in the regulation. So I can really, the way that at least I see the trends having moved in the last 4 to 5 years would be really broadly in 2 buckets. One is where they're trying to be more pragmatic, simplify procedures, make it more enabling for people to actually be able to do business and transactions more specifically. And the second one is where they're basically trying to aid and assist their own surveillance, their own monitoring and regulation mechanisms. Now, in the first bucket, really, the kind of changes we've seen, for instance, we're all aware of the recent changes around the system-driven disclosures, right? What that does now is it takes away the compliance burden from the individuals, whether be it their promoter group, designated employees. Up until now, I mean, we were just discussing about this, how far is it just about self-disclosure? And I think that was a lacuna a lot of people saw, that where there was lack of disclosure by persons who should have disclosed under the regulations, the effect of that was basically not only just on the fact that yes, whenever it was discovered that would have to be made good later on in time, but what I think SEBI also went through was the inability to have that data with them at the right time also made it difficult for them to be able to, be able to track what was going on apart from just the non-disclosure. The non-disclosure aspect would just be, I didn't disclose a trade, but was there more to it? Was it a trade that also involved insider trading? And what that resulted in was a lot of delays. And once these matters actually went to court, even though under our regulations there isn't a limitation period, I think at the appellate levels, a lot of times you do see the appellate court sort of not taking very kindly to the fact that SEBI's enforcement is so delayed and protracted that at times, once by the time it comes to court, these are trades that took place 6 years, 7 years, 8 years, 10 years before they're actually in court, and the courts tend to have some sympathy with that. And I think in line with that, we've seen system-driven disclosures come through, where now it's basically it's just going to go directly based on the stock exchanges and depository data, etc. These are alerts that go through directly to the stock exchanges. So, you no longer are relying on only self-declaration, because that's not, as we were discussing, that's not always foolproof. And then it has ramifications for the regulatory and enforcement process anyway. Apart from that, I think, so that's on the simplification part of it. What we've also seen is enabling the ease of doing transactions, right? So now there is the ability for companies to be able to engage in facilitation of due diligence exercise, etc., by actually formulating a legitimate purposes policy, and that is sort of delegated down to the board of the company, where the board decides when it deems it in the best interest of the company to share unpublished price-sensitive information in the context of, for instance, an M&A transaction, an acquisition transaction. And it allows the company to come up with a policy. And as long as you follow that policy, and of course they're subject to some further do's and don'ts, etc. But as long as those boxes are checked, there is actually the ability to facilitate that due diligence, to facilitate the exchange of information, which ultimately is resulting in a transaction. Apart from that, we've also seen subtle changes, but changes which actually have large ramifications. The whole question around what is UPSI has always been, I think it continues to be and forever will be a question that no one will have the right answer to. But I think one thing that people struggle with as regards the interplay between regulations is that the listing regulations have something called the material events, where there are deemed material events, which must be reported as material events under Regulation 30 of the listing regulations, versus UPSI, which is sort of broader. And the trouble I think a lot of people faced was that material events prior to, I think 2019 is when that change came about, all material events were deemed to be UPSI. And that sort of created trouble because the two lists are not necessarily the two lists of what is deemed to be a material event and what is deemed to be UPSI is not really, they're not aligned. And a lot of the times, just because you were disclosing something as a material event, automatically also became UPSI. And then, there was a lot of disconnect between the two, and it increased the company's compliance requirements on the UPSI end, because, when there's UPSI in the company, you have to close the trading window. There are certain other compliances that you have to follow. And we saw that change come through, I think, when the market made SEBI aware of this difficulty in the interplay between the two regulations. We saw that change come about. So all of these changes, I think, have been in the bucket of where, they've heard the market, there's some simplification, there's some enabling, there's some pragmatic approach being taken. The other sort of bucket, like I said, was the where you see SEBI more and more being able to coming up with regulations that aid and assist its own ability to be able to gather data at the time when it needs to enforce and it needs to implement and sort of gather data around in an enforcement proceeding. And those are changes, for instance, the structured digital database. Again, I think it's a double-edged sword. I think a lot of people are struggling with it quite a bit, given the way in which data has to be gathered and how it has to be recorded. There are difficulties on private and personal information, GDPR, this, that, and the other. So a lot of issues to be ironed out. But I think where it's aimed at is the ability for SEBI, when it notices that something or it feels that that there might have been some foul play somewhere, it should have the ability to go directly to the company and get that data in one shot without it taking time. That here is the list of people who had access to all of this information. Similarly, they've gone ahead and extended that to fiduciaries, and those are people like Grant Thornton and us, who, even though we are not actually regulated by SEBI, so to speak, there is a fairly onerous requirement on us to be able to not only have an insider trading code of conduct, but also to now have a structured digital database in place, which is required to cover our own persons as well as people who we receive this information from, who we pass it on to. All of this is actually aimed at SEBI having easy access to information. So it's kind of delegated its own, I don't want to say its own responsibilities, but in some measure, record keeping is down to entities, and that record keeping is accessible to SEBI at request. And similarly, we've seen the informant mechanism come about, where I think what SEBI is trying to do is urge and encourage people who have knowledge about insider trading to come forward make it easier for them to assist SEBI in uncovering and proving and establishing, which has always been an issue, and we can maybe come to that slightly later. But I think that's a major change that we've seen. It borrows very heavily from the US whistleblower mechanism, and it kind of that's the other place where we see them, reaching out to to entities and to just general market participants and the public in assisting their own investigation and their own ability to discharge the burden of proof that they need to when they actually take enforcement actions. So that's generally the sort of trend that we see. I think when it comes to for the orders that SEBI passes, I think those are key as well. In at least very recently, what we've seen is there seems to be a trend from that SEBI seems to have been taking a position where it does want organizations, in particular listed companies, to take on a more active monitoring role, to be a lot more sort of attuned and dynamic, and not just that here is a regulation and we are following it just the way that we were discussing with Tushar and you, Dinesh, just before this. I think the idea for SEBI is constantly monitor, be aware of what your employees are doing or not doing, and sort of don't just take a check the box kind of an approach. Yes, there are policies that you're required to adopt, but I think those policies are now expected to be applied and implemented mindfully. So you can't just have a policy that says any information that can be price sensitive and is not generally available is UPSI. If your policy also says exactly that, it's too wide. And what that does is makes the job of a compliance officer also very difficult to actually apply something like that to a real world situation. And that's what SEBI wants. SEBI wants at all points in time now for companies to be very mindfully doing this, to be doing this very actively. It's not just a side piece that this is a compliance and a regulatory burden. I think this is something that they want listed companies to be very, very mindful at all points in time about, and take this very seriously. And a compliance officer's job, I think, today has become very important. And I think companies will have to start, if they're not already, will have to start really focusing on this a lot more. I'll pause here and take any follow-on questions.
No, I will come back to you, Manjari, and very important insights you've given to us on the overall, changes on the regulation. One being pragmatic, the second being more from a monitoring and a surveillance perspective, and the fact that now SEBI wants structured databases to be maintained. They want easy access to information, responsibility being passed on. But on that, I guess a question to Samir, who day in and day out is helping company sort out some of the problems which they come to. Samir, how difficult, in your opinion, is it to gather evidence of UPSI? And we've already discussed that, how do you, the term UPSI, you can keep discussing it. What is UPSI? How do you classify it? So how difficult is it to gather evidence if there has been a misuse of UPSI without having a digital or electronic medium?
Okay. So Dinesh, there are two parts to it, right? As I said in my presentation, one, there is the UPSI, which got in the hands of the insider. The insider passed it on to some connected person who took a position, squared off position, made money. That's how typically it works. Now, as you rightly said, the slam dunk is if you have any electronic information, emails, WhatsApp chats that land up where you can see the insider tipping of the connected person, and then there is evidence in the form of connected person taking position. Slam dunk, no problem. Now, when that is not there, obviously, then we get into the circumstantial evidence category, leading to where you're trying to everything make it as a circumstantial evidence. And I'll give you one example that we had done. So there was this case whereby there was for a financial institution, there was a person who used to look after its money, an investment manager, let's call him. And there was a suspicion that a completely unrelated person was taking positions based on tips given by this individual, the investment manager. Now, we went through all sorts of data to try and see if this particular individual has any connection with this investment manager. The answer came no. no relatives, no friends, no Facebook connect, nothing of that sort. So then we led to a little bit of what is called as old style market intelligence. So we literally surveilled the guy. We put one of our guy to follow this investment manager for 2 days around town. And what emerged was this investment manager used to take a carpool every day to go from the suburbs to his office in town. And this connected person used to take the same carpool. And that's where the information used to get sparked. If we would not have done surveillance, there was no hope in hell for getting even a circumstantial evidence. So, which is what we then presented to the management. The case was clear, but from a conviction perspective, was it good enough? Because none of them obviously admitted to their sin. From a conviction perspective, was it good enough or not? That's still apparently still going on. So clearly, when there is no electronic evidence, which is a slam dunk, you have to sort of think out of the box and look at everything, including surveillance, looking at their phone bills to see who has been in touch with whom. But as I say, that is all in the realms of circumstantial evidence and not a surefire silver bullet.
No, and very relevant because I guess even in the past, whenever we have done so many investigations where we had to rely, where we found adequate intelligence, market intelligence, but market intelligence unfortunately has a hearsay element and cannot be really presented, as evidence in a court. Moving on and just sticking to UPSI and Swami, again, talking about the fact that, now SEBI wants access to a lot of information. How is your organization using technology for tracking UPSI? And how are you also, you had touched upon it a little bit in the beginning, but how do you ensure that the access is available only to authorized representatives? I think you're on mute, Swami, sorry.
As always, yeah. Okay. So two things. You have a software at the front end, the Bloomberg kind of a software, which has the relevant controls and checks in place in terms of who can do debt markets, who can do equity markets, and up to what limits and what levels and things like that. So that's one part of it. Okay, and that takes care of access to that information. That also takes care of the phone calls that you do in terms of recording things like that. I'll come to how we are handling it during this lockdown time. That's one. The mid office and the back office is a SAP system, SAP system, and that also takes care of your access controls and checks and the monitoring controls and helps us in kind of concurrent review of the trades that are happening and the trends that are the trends that are there, and that's how we kind of effectively monitor the entire investment compliance, the trading compliances. Having said that, more from a during this lockdown time, even before SEBI, even before IRDA could lay down stipulations on how do you know that the fact that you need to monitor trades that are done by employees from their residences, we have put in recorded lines systems specifically for those trades and for the employees who do the investment trades, and all those are also kind of monitored. So digitally, that's how we kind of track them, and this lockdown hasn't had any impact on those kind of controls. So it's kind of worked well for us.
No, thank you, Swami. And moving on to Tushar. Tushar, you had mentioned earlier, that your company, being a listed company, has got a insider trading tool, right? And just on this, it'll be good to get just some quick insights in, what it is. It's a tool which I understand you develop yourself. So if you can throw some insights on what is it that this tool is able to do, which helps you to keep a vigilant eye on what is happening.
Yeah, actually this tool is not developed by us. It is availed from our external agency, our transfer agents. So, this tool, what we have done is, we have provided them, means we had provided them around 3 to 4 years back, list of all designated officials of the organization, along with their PAN account number details and all that, names with designations and all that, they are in which departments and all that. So based on that, based on that internal software, since the names of the officials are already logged with them, they are able to trace, if, out of this, say, 300 people, if somebody has bought the shares during the particular month or not. And by and large, it is a nil report. But, as and when one or two cases which had come, but those, there was a appropriate pre-clearance process was already in place. So we were already aware. So it automatically helps us to understand on a monthly basis, everything is going on well or not. And we have also informed, within the organization also, we have informed that we have this tool in place, so that, consciousness of these provisions of the law and the consequences are already known to majority of the employees, So that is the way it operates. And apart from that, I forgot to tell you, what we do now, this, press release, whatever we have to communicate to media, we see that copy of that press release also is notified to the stock exchange well in advance, so that the information dissemination is to the public at large prior to, even insiders knowing, so let the world know first, okay, this is a media press release, then it goes to the media. So that also is I would say it's a good practice, or a good practice of disclosure, that you are informing, there is a dissemination of information to the outside world first. And see, incidentally, our meetings are planned, say about 11 or 11:30 a.m. So by the time it gets over, it is always, 4:30 or so. So that also helps us that, we are not disseminating any information, say about financial results, by and large, financial results or something during the trading hours, that is also automatic, because it is then, after the trading hours, if you send, then everybody will know, right? And the very next day it gets published in the newspaper. Though, as per the provisions, it is, two working days are allowed, but we have always ensured that our financial results gets published the very next day. So these are the ways, we generally, consciously do whatever in the best manner, so that, designation is at one stroke to everybody.
Now that's a brilliant point, that, I love what you said, that, your meeting always ends after trading hours. Information, there is very little to leak because you make it public. So I think that's a great takeaway, I would say. I know, I think Sameer, I don't know what's the time thing, but I just have a couple of more quick questions. One back to you, Tushar, and just taking off again, we've all, and you have touched upon it in the past on the trading window and the closure of trading window, and how this is a very important compliance under prevention of insider trading regulations. But in your experience, how is it that it has led to control of insider trading? Do you think it's really something which is effective, or not? Just to have some quick insights from you.
Yeah, definitely it is effective, because by law and by mandate it is sent once in a quarter. Then, as and when there is any reported judgments, say like what we heard of, one of the prominent banks or IT companies, which are all in the public domain, we prepare a summarized note on that, and we circulate to the same set of people in maybe a wider group, just for creating a compliance awareness on the subject. And also, it is also, about the tool, everybody is aware within the organization. And we have also, extended this, designated list of officials to a very wide audience, and it may include a very junior assistants as well. Say in some corporate communication department or finance department, or be it a project planning department, even very junior people are also covered, those who may be having a unpublished price sensitive information. So, so there is a wide coverage, so all these controls definitely help actually.
No, great, great. Thank you for that, Tushar. And just quickly moving to you, back to you, Manjari. And Sameer touched upon it that in one of his slides that globally insider trading cases are anyway very difficult to prove, more so in India. And in India, we've seen that the conviction rate has been very low. What are some of the changes? And of course, we spoke about the whole reward which SEBI has done in terms of the whistleblower reward being increased to encourage more people to come out. But what are some of the changes which you think which can be further done to increase the whole conviction rate?
Sure. So I think, Sameer, Dinesh, the problem really is that of evidence. And as we've been discussing, it's not always easy to prove these insider trading cases. At the end of the day, you need not just, as Sameer was touching upon earlier, not just circumstantial evidence, but something that is direct and concrete and goes to actually prove that there was information and there was trading on the basis of that information. And it's that link that unfortunately is very difficult to draw. In particular, it's at times gets extremely difficult to be able to prove that there was actual access to UPSI, in particular, where it's not just an employee, where it's somebody outside of the organization. Through and probably the link is through somebody in the organization or a partner, if there's an acquisition going on, the counterparty, etc. So there's a lot of links to draw, and it's like going down the rabbit hole, and it's not always easy to be able to prove that. And that's really what I think globally people have suffered from. Our own regulator, I think, has traditionally suffered from it. I think things are on the right track now, and I think really the only solution to all of this is technology. First of all, it's about identifying. It's about identifying, and that's step one, right? When you're actually able to catch a trade that's not fair game, right? And we have huge volumes of trade in this country between derivatives and equity. There are above, if I'm not mistaken, the data that I last saw was about 550 crore transactions every day. Between equities and derivatives, and that's large volume of data, and people who are engaging in either insider trading or front running or any other kind of manipulative sort of trading practice, they're generally doing it smartly. And what they're doing is they're also deploying evasive mechanisms. Their trading patterns are complex. It's difficult to be able to first of all identify where the sort of unfair trade really lies. And for that, I think much like all of the corporate world is now realizing, data is really key to everything. And I think our own regulator has now deployed a lot of IP-based tools in order to be able to actually first recognize trading patterns which are possibly suspect. And then, of course, starting an investigation and gathering evidence in order to evidence to prove whether or not, first of all, to identify and form a prima facie view as to whether it is something that requires a more full-fledged investigation into it. And if you see, there are some recent orders that SEBI has passed, which give us fair insight into into the new tools that they're using. One of the ones that they've developed in-house is this Delta tool, which is basically what it does is it analyzes close to 20 million trades a day. It's able to mine and process data, and it's something that was developed by the surveillance team and the IT teams in-house at SEBI. And what it is able to do, like I was saying, was to mine and process data as many as 20,000 trades across F&O and equity derivatives and equity trades. And it's specifically aimed at being able to filter out evasive sort of strategies that people use, where what people do is they'll have a few contrary positions taken in, so it becomes very difficult to be able to gauge which way you're actually trading, because you'll have 10 trades going one way, you'll have 3 going the other, and someone who's sitting behind a computer and trying to make sense of it may not be able to do it in time, and certainly may not be able to do it as efficiently. This tool, what it does is it basically nets off, pairs off, and tries to be able to figure out what is the position that a particular trader is taking. And on the basis of this, in the recent few orders, SEBI has actually used this tool and been able to establish, despite the fact that there were possibly some evasive trading techniques and complex trading patterns used, they're able to actually, based on net positions, sort of establish that this is the way, that this is the position really that the trader was taking, irrespective of, if you look at all the trades, they might look like they're vague and they might look like they're not really going anywhere, but they are. So I think really technology, which is aimed at detecting these complex and evolving manipulation techniques and abnormal trading patterns, those are actually, deployment of those will actually be key for SEBI. And like I said, I think they're on the right track. I think they are using and they're focusing a lot on technology. They've been doing that historically as well. I just think a lot more is available today. And I think they're now focusing quite a bit on it. There's a huge technology budget that they generally sort of allocate to, to come up with these tools. And, basically simulate human intelligence, which will, one, cut down on time, which is, I think, the most important thing. Because I think, we've all heard the phrase of justice delayed is justice denied. And, similarly in this, that the longer it takes for you to investigate, the longer it takes for you to bring people to task, the less effective the real regulatory system appears to be. People are then think that they can get away with it and we'll see what happens 10 years later, but that's not what it is anymore. I think that there's more speed. We're still lagging behind. I think we're still in a place where SEBI is possibly, enforcing, in particularly on transactions, we're still probably seeing trades today being brought to task, which are possibly done 2 years back, etc. But at least we're out of the space where it used to be like 6 years, 7 years, 10 years too late. So yeah, I think we're seeing a trend and we're seeing a change. I think the more and more all of this is used, and I think what's also key, sorry, I think I missed on that part. I think SEBI has been asking for some more powers for a while now. There was a fair market conduct report in 2018, where while SEBI does have the ability to seek call records, they don't have the ability to, at the moment, even now, don't have the ability to listen to calls, to tap calls, or to be able to get transcripts of calls. I think this has issues of its own, and I think that the general policy makers need to take a call on when that is right to do, to what extent, what are the checks and balances that need to be in place, etc. But I think that's one thing that SEBI has been saying is a bit difficult for it to do, because at times what does happen when you only base it on records, just call records, I spoke to you, I could have been speaking to you or inquiring about your health. But, unfortunately, if there's been a trade and there's something I am privy to and you've traded, if you just pull out the call records, it's circumstantial evidence, very easy for someone to say, well, I called Dinesh and I spoke to him and Dinesh then put in a trade. But I could just have been talking to you about the weather. And that's where the actual call record and not just the fact that the call was made becomes a bit important. But I don't think we're there yet, and it remains to be seen. But I think at least when it comes to, like I was going back, without belaboring the point, I think technology deployment and also being able to, and I think what they've already been doing in terms of, and I touched upon it earlier, being able to get access to information from companies, from fiduciaries like yourselves and us. All of that put together, I think, kind of joins all the pieces. So I think it's evolving, but I think we're in a place where you will see more and more convictions, if that's what we all want. We're just hoping that they're all in the right, they're the right convictions. And, you're not sort of missing the woods for the trees.
No, that's very insightful, and thank you. And I think I completely agree with you. More conviction is needed, but more right conviction, and it's not, it shouldn't become something where it kind of deters people from doing what they have to do. I know we've run out of time, Sameer, so I'm going to just hand it back to you. But before that, I just want to firstly, thank the panelists again, Tushar, Swami and Manjari, thank you very much for joining this session. I know there are lots of questions which are there. I don't know, Sameer, if you want to address them later and email to all the participants the answers, but let me hand that over to you to take that forward. Yeah, thank you very much to the panelists.
Thanks, Dinesh, and thanks the panelists for an absolutely enriching session. It was a pleasure to be on the session and just to listen in and not do anything else. So thanks so much, Swami sir, Tushar, Manjari, and Dinesh for your inputs. As I said, there are about 19 questions. We will probably get in touch with all those questioners and probably sort of take it forward. We may come back to you, Swami sir, Tushar, and Manjari for your inputs once we respond to these questions. And thank you once again for your time. And thanks to all the people who have dialed in. It was many thanks for taking out time to attend this session. We hope it added some value to you, and at least all of us on the panel had a great time and for this absolutely robust exchange of ideas. Till next time, thank you so much. Have a nice evening. Bye-bye.
Thank you.